Hello and welcome to your CIMA F1 Financial Operations Chapter 7 in your Express Notes at page 32. I assume all of you have downloaded a set of notes and you're ready to cover IAS 36 impairment of assets. Impairment, first of all, means a decrease. Impairment of assets therefore must be related to a decrease in the value of the assets, and therefore how we account for that decrease in the value of the assets into our financial statements. According to prudence concept, which hopefully all of you remember, we cannot overstate our assets in the statement of financial position or understate our liabilities, and therefore our assets must have a very prudent value in the statement of financial position. And in order to ensure that amount is prudent, we're going to have to prepare a test we'll discuss in a minute and compare the carrying value, the value that you keep in the statement of financial position, your non-current asset at a point in time, and compare it with what we call recoverable value. So remember this concept of recoverable value, we'll come back to it, but you compare these two, the carrying value in statement of financial position and the recoverable value, you're going to calculate separately on a separate sheet of paper, and because you want to be prudent, you're going to take the lower of these two amounts. Okay, and remember, we'll explain in a few minutes what recoverable amount is. But before that, I just want to underline impairment of assets for most assets would occur occasionally, and you have to observe certain factors, could be external or internal. And for an asset such as goodwill, it is encouraged to have an active test for impairment. So let's see what would be the signs. So if you move on to the next page into this chapter, I'll skip a little bit of a discussion you had there on recoverable amount, just to point out a bit the indicators of impairment. So an impairment can be affecting your asset based on external conditions, and that could be due to a sudden drop in the market. If you think due to the financial crisis, how many real estate buildings and land dropped in value, and that's a clearly external independent factor from your own organization, and those assets may be impaired because they cannot be they don't have anymore the same value for transaction. But also the decrease in value of your asset could occur if you have some internal factors or reasons such as obsolescence, or for instance you have old technology, old equipment, and that of course would be an indicator of impairment, of potential decrease in value of that asset. And of course any physical damage, or if the assets are underperforming, these would be other subsequent indicators of potential impairment. So in real life, let's say you identify there are some signs, some indicators that your non-current asset, your asset could suffer a decrease in value. So what do? Well, you know the value of your asset into the statement of financial position. Now, we were saying earlier you have to compare it with the recoverable value. So I know my carrying value in statement of financial position, pick it up from there, and compare it to what we call recoverable amount. And because you want to be prudent, you are going to take the lower of these two. However, while you know this one, because you could see it in your statement of financial position, how do we calculate this recoverable amount? And imagine you're looking at your non-current assets from two angles. The recoverable amount could mean how much do I earn on that asset if I sell it? In other words, how much do I get? Well, I get the fair value, the value you sell it for, less than any cost incidental to sale. So how much do I get from selling it? Or virtually, if I don't want to sell it, how much do I get from that asset by using it in the business continuously? So I'm going to try to assess that. You could argue fair value is quite straightforward, less cost to sell of a non-current asset, especially if there is a market, a second-hand market for that particular non-current asset. You'll have that fair value and you know the cost incidental to sell, so you get that component here. How do you get value in use? Well, that's a challenge in real life, but what you need for this paper for your exam is to know that value in use is basically based on the future cash flows generated by this particular asset by holding on to it in net present value terms. And that's not very easy in real life, but that's how you calculate values. And all you need to know is to know for this paper, for CIMA F1, only this logic, basically this flow of judgment. So we are still determining recoverable amount. Let's say I have a figure for fair value. Maybe the value in use will be given to you. What do? You take the higher of the two. So let's say fair value is 10 and value in use is 12. I'm taking the higher of the two, 12. I have my recoverable amount 12, and let's say the carrying value was, let me invent something higher than 12, 15. So what do we have to do now? We have to think, we have to be prudent, and I have in my statement of financial position a higher value than recoverable amount of how much I can recover on that asset. So that is not prudent. Therefore, I have to reduce my carrying value. I have a reduction in the value of my non-current asset of 3. So you could argue the difference between 15 and 12, it's what we call an impairment loss. Hopefully everyone is fairly clear on this test. It all goes back to prudence, and you want to make sure this carrying value is not overstated. And in this tiny bit of example here, it was overstated, so I had to reduce the value of my non-current asset from 15 to 12, and we'll discuss a bit later what's the double entry, because clearly you have a reduction in non-current asset, and where would it go? Well, I'll let you think about it, and we can move on very briefly to the next page. So remember that point. What does it happen? So how do I record that? The key thing what we wanted to emphasize is you have to reduce the non-current asset value to the lower of carrying value and recoverable amount. Now we touched upon the indicators. I would like to take you to cash generating units. Now, not always you have an asset that generates independent cash flows. And if that's the case, you're going to have to search for what we call a cash generating unit. And I have to say, I like this definition. A cash generating unit is the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or group of assets. So that's your cash generating unit. Now I'll give you an example of a non-current asset, and let's see if we can basically test it for impairment on its own. Imagine you have a pizza restaurant, you are the owner of a pizza restaurant, and the oven in that pizza, can you put a value on it as such in terms of testing it for impairment? Do you think it would suffer market conditions, or could suffer obsolescence and so on? But you could argue that that particular oven does not generate independent cash flows, and it's better if you evaluate it in the context of the whole maybe pizzeria, because it is the pizzeria overall as a cash generating unit. So what you're trying to say is that item generating independent cash flows or not? A good example could be also if you think, let's say, a fun park like Disneyland or something like that, and you have a train that would take you within the park from a ride to another. Is that train generating independent cash flows, or is that part of a bigger thing which would be part of a cash generating unit, a conglomeration of non-current assets? You would argue if you don't charge for it and all it does, it takes you from a ride to another, it does not generate independent cash flows, therefore that's part of the park, part of the non-current assets, or part of the valuation of the park itself. So if you have a train though that, let's say, takes you from the nearest village to the park, then clearly you have it generates independent cash flows, and then you could say that particular train can be tested independently for impairment. So what we are saying, okay, whether it's an example with the train or the example with the oven in the pizzeria, is that is it likely for these non-current assets to suffer impairment on their own, or more likely as part of the overall business? and you would have to look if they are able to generate largely independent cash flows from other assets and group of assets. Okay, if as a final point I let you with some thought, some idea on a point, we were saying about the impairment loss. How do we report impairment losses? Well, if you think of individual assets, so not the cash generating units, the CGUs I mentioned earlier, we had an example, we had an impairment loss of 3. What do we have to do? We have to reverse any prior evaluation gain in equity. So in other words, if that non-current asset had a revaluation reserve in relation to it, I would have to reduce that first. And then if I have any excess so my impairment loss is higher than the revaluation gain, that excess will go into the into the P&L, into the statement of comprehensive income. So it's only then the difference goes there. If there was no revaluation prior to the impairment test and the impairment loss assessment, then you charge it all to P&L, to the profits, against profits. What happens if you have an impairment loss in the cash generating unit situation? Well, let's say, you know, the oven explodes or something as dramatic as that. And what do you have to do? Obviously, you have to impair first the value of that particular oven. Then, if the impairment is quite high due to the fact that oven exploded, then you would have to go and take away from the goodwill attributable to the CGU. So in other words, to the maybe pizzeria overall as a business, as the value of the business will decrease if there was any goodwill there with the excess impairment. And if there is still some impairment left after you allocate it to the value of the item damaged, you reduced and basically made disappear any potential goodwill that existed. Any remaining impairment loss, you will allocate it on a pro rata basis to the value of your assets. But remember, very important, never impair an asset below its individual recoverable value. Make sure when you practice questions, you pay attention to this. Never impair an asset below its individual recoverable amount, okay? Alright, I think I'll leave you to this part, and please make sure you are familiar with this particular part here. I think this is very important to understand the impairment test and how you calculate the impairment loss. That's important. And also to know how you treat that impairment loss, and ultimately to be able to identify some external and internal factors that could indicate potential impairment affects your non-current assets. Thank you very much for your attention, and look forward to being in touch with you to other videos. Until then, best of luck with prepping.